The election. The election is a coin flip, they say. The US presidential election is naturally dominating the minds of most investors. When faced with such uncertainty, it is tempting to position portfolios to benefit from a particular outcome. Such a strategy is grounded in the assumption that other investors have mispriced the probability or impact of that outcome. While that may be true in some circumstances, it seems unlikely this year, given how close the race is. This means positioning a portfolio for a particular outcome is literally a coin flip, and one should not, I repeat, not risk a lot of capital on it. We should instead be positioning our portfolios to withstand a range of scenarios and looking for opportunities that the market adjusts to whatever new political reality emerges after November 5th. To this end, Danny. Good morning, everyone. It is October 31st. Happy Halloween. Sorry I'm not dressed up. I haven't done a retirement planning coffee talk in quite a long time, so I appreciate those of you who decide to stop by or watch this. I will record it and post it at a later date, or hopefully later today, but you'll be able to watch it at a later date. So with that, I apologize for being a few minutes late. I definitely was having some computer issues and got a little bit of a late exit out of my home this morning. Sometimes it's just hard to say goodbye to the little ones, but that's no excuse. I'm just making up excuses. I was running slow, so I apologize. For those who haven't been with me before on Retirement Planning Coffee Talk, these weekly retirement planning coffee talks are an informal way for me to have conversations and answer questions with people, even if they are not my clients, for free. You are welcome to join this Facebook Live or stop by my office for free coffee. Note that I have changed locations now. I'm out at the Fricky Plaza, which is 1520 Highway 32 East, Suite E. So it's kind of a shared space. There are other offices around, so I'll have my door slightly cracked. But if you do come to hang out with me and have coffee, which people have in the past during these retirement planning coffee talks, just knock and come on in. Otherwise, normally I would have my door open or closed completely, not just slightly cracked. But with that being said, there's no pressure to work with me or become my client by stopping by in person or online. It is my mission to provide the highest quality advice and service possible to my clients. Therefore, I limit myself to only having 100 or less active clients at all times that I have a fiduciary responsibility to. Even though I limit myself to only working with 100 clients at any given time, it is still important to me to provide as much value to as many good people as I possibly can. And that's why I do these videos, that's why I do Money Not Math videos, and that's why anyone who wants to meet with me, I'll absolutely meet with you. It just may not make sense for us to professionally work together and you actually hire me, because I really want to maintain that commitment to my 100 or less clients, that I provide the highest quality service and advice possible to them while helping as many good people as I can. All right, so disclaimer, this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation. And this is live, so I may make a mistake from time to time, but I'll do my best to give the best answers possible. So I look forward to some great conversations and hope you have a wonderful day. With that, are there any questions to start? If you have some, please put them in the comment section now or any time during this live video. I'll do my best to answer them either live, or I'll do a follow-up video to answer them, or you can DM me and I'll reach out to you directly and answer your questions. I have 1 hour set aside on my calendar to answer questions today. Usually I have an hour. Today I'm only going to be doing until about 9:10, depending on how many questions there are, because I do have meetings back to back to back after this that I want to make sure I'm on time for. So with that being said, please, like I said, I would love to spend this entire time just answering your questions, retirement planning related or money related, anything financial planning related. I'm happy to discuss. Heck, if you want to talk about the Vikings, I'll talk about the Vikings. I'd rather have a conversation with you than just talk at you. But if I don't receive any questions, I'll try to find some quality articles that I can read and review to give you some perspective on things maybe that you should be thinking about when it comes to your retirement planning. Give people a moment here to ask questions if they have them. And while I'm waiting to see if there are any questions, I will look up some potentially valuable video or articles for us to discuss. I apologize, I have a head cold, like I'm sure many people do, so I sound a little congested. All right, so I haven't received a question yet. I hope I receive some as we go here. But while we kill some time, or hopefully provide some value, I'm going to review an article from Morningstar.com, and it is titled "What Investors Told Us They Want from Advisors." So I'd be really curious to hear your guys' feedback on what you're looking for in an advisor. My goal is always to provide high quality service and trust and advice, but sometimes people are looking for different things. So it would be interesting to hear what you guys think while I'm reading this article. And of course, like I said, please ask questions if you have them. So it says, this is written by Cheryl Rawling. How advisors can serve two distinct groups, wealthy clients and young investors. Earlier this year, Morningstar conducted its Voice of the Investor survey, which interviewed 4,645 investors and non-investors from the United States, United Kingdom, and Australia. An additional study surveyed 506 investors who'd work with a financial advisor to gain insights into advisor fees. I want to explore responses from two specific groups that might be most relevant to advisors. Wealthy investors, those who have at least $500,000 in investable assets, and young investors. Advisors typically serving well-off clients need to also attract younger investors to grow their practice and survive long-term. The characteristics and needs of these two distinct investor groups must be truly understood by advisors to position themselves as sought-after partners while delivering exceptional value. Serving wealthy investors. Wealthy investors require high-quality, proactive advice. In reviewing the responses from these investors in Morningstar studies, the following key insights were apparent. Personalized tax-savvy strategies. Wealthy investors value advisors who can minimize their tax liabilities and provide individualized financial plans. According to the fees study, wealthy clients are willing to pay professional fees to advisors with expertise in complex financial and tax matters who can develop strategies that align with their specific circumstances. So whether you're wealthy or not, are personalized plans that are tax savvy something you've been thinking about? Complex financial situations. Wealthy investors often require advice in the areas of estate planning, risk management, and long-term tax strategies. These investors need counsel in determining how best to allocate their assets between themselves, future generations, and charity for Uncle Sam. They also need personalized planning to integrate portfolio assets along with their other investments such as real estate and private equity. More than 2/3 of wealthy investors in the survey use the service of an advisor. Fewer than 1/4 of investors with smaller portfolios under 100,000 use an advisor. So that's kind of interesting, isn't it? So people with more money, $500,000 or more, 2 out of 3 utilize an advisor. People with less money, less than 100,000, only 1 out of 4 use an advisor. So my curiosity is, with people with more money, do they take money more seriously, so they hire an advisor? Or is it that people with less money don't feel like they have enough money to hire an advisor? Or on the flip side, do people with less money just not quite take money seriously, right? So it's very intriguing that as people get more money, they're more willing to take advice. When with people with less money, they're less willing. And I'd be very curious to hear your guys' opinion of why that is. Using a golf example, or any professional sport example, I would love to hear one professional athlete, one, that does not have a coach, or a swing coach, or a health coach, or an advisor of some sort, right? So the more serious people get in their sport, using that as an example, almost 100%, as far as I'm aware, they all have advisors and coaches and people that have non-emotional attachments to their game to give them advice. However, when people are just getting started out, it's like we think we can do it all ourselves, which I think is very interesting. And I'd be, again, curious what you guys think when it comes to financial planning. So, and just so you know, it's never too early to hire a golf coach or a financial advisor. Now, you may have to find the right one for you, because not all financial advisors are going to work with people who are just starting off, or maybe they are not positioned to do so. But it is always valuable to have someone who has less emotion tied to the outcome, giving you perspective. It's not just a question of and plus access to resources. It's not just a question of who can afford to pay for advice. Those with larger portfolios have more complex financial situations, per the survey, and thus have a greater need for expert advice. Well, that's what she said, so that's what kind of answers my question a little bit. Proactive advice. Wealthy investors are willing to pay for and expect proactive advice. They want their advisors to identify opportunities, address potential risks, discuss market trends, anticipate tax law changes, and provide timely advice. It might sound like a lot, but a wealthy client is paying higher fees than other clients. They expect premium service for that. Recommendations for advisors with wealthy clients. To attract and retain, oh, they're talking about the advisor side. We don't have to go into that because that's more for me than with you guys. But the big things they're focusing on: communicate proactively. I think that's valuable. Build trust, leverage technology, serving. So now we're talking about serving young investors. Again, I'd be curious to hear for those who check in what your thoughts are between wealthy investors, young investors, and just what your opinions are of how advisors should be treating their clients or what you're looking for in an advisor. Attracting young investors is critical to the long-term survival of an advisory firm. To do so, advisors must understand that young investors have quite different priorities and needs than older, more financially affluent investors, including education, targeted planning services, environmental, social, and governance investing. Education. Young investors often seek guidance in education on financial topics relevant to them. For example, more than 1/3 of millennials and Gen Zers invest, to some degree, in crypto assets. Even if an advisor does not encourage these investments, it's important to be able to speak from a point of knowledge. According to Morningstar's advisor fee study, younger investors are more likely to value advisors who provide educational resources and support. This indicates a desire for advisors who can help them develop a strong financial foundation and make informed decisions. Targeted planning services. Despite short-term challenges like student debt, young investors have a long investment horizon and prioritize building wealth for the future. Unlike older, wealthier investors, young investors need help with reducing student debt, budgeting, establishing a cash safety net, saving for a home, and setting annual savings goals. ESG investing. According to the Morningstar survey, young investors are somewhat more inclined to seek investment and opportunities that align with their values. Interestingly, the preference difference between young investors and wealthy investors is not huge. About 2/3 of young investors want investments that positively consider their personal values and avoid investing in certain industries, like weapons or tobacco, versus about 1/2 of wealthy investors. So that's interesting. Young people care more about what they're investing in than wealthy investors. Now they're talking about recommendations for young investor or advisor working with young investors. We won't go into that because again, that's more for the advisor. But again, I think that's very interesting how they separate out wealthy investors versus young investors. The two main points I can recall from that was one, more wealthy investors actually hire advisors than young investors, and young investors are more interested in what they're investing in versus just the outcome of the investment. So I'd love to hear your guys' thoughts, and I will post this article in the comments in case you'd like to check it out for yourself. All right, seeing no new questions, I will pull up another article here. This one's also from Morningstar.com. And it says, Markets Brief, Don't Gamble on the 2024 Election. Plus Earnings, Season Games, Inflation, and GDP Data, and Sentiment-Driven Investing by Dan Kemp. So I might skip over some parts of this if it gets way too in the weeds, but hopefully I can provide some value by highlighting this article. Tesla back in favor. U.S. stocks fell last week, led by the basic materials and healthcare sectors. Previously overpriced, both are back in line with Morningstar's estimates of their average stock's fair value. In contrast, consumer cyclicals delivered a positive return, supported by Tesla, which accounts for about 14.48% of the Morningstar U.S. Consumer Cyclical Index. The stock rose 22% over the week as investors appeared to forget the disappointment of the recent cybercab event and were enthused by CEO Elon Musk's optimistic predictions. Elon Musk must be the most interesting man in the world right now. It's amazing how polarizing he is. On one end, people love him. On the other end, people hate him. One week, he's the biggest failure in business history. The next week, he's the richest man in the world because he's got this great idea. It's quite fascinating to... I don't follow him very closely, but anytime you hear about Elon Musk, it's something dramatic, it seems like, or drastic. Investor sentiment changes all the time. As most of Tesla's value is derived from the anticipated success of future products, slight changes to these expectations have an outsized impact on its stock price. Because of this, it's important to have an independent perspective on the company's true value. Such an anchor helps reduce one's sensitivity to changes in investor sentiment. Analyst Seth Goldstein increased his estimate of the company's fair value by 5%. The firm now appears significantly overpriced in most scenarios. So that's an interesting concept. Basically, what they're saying is you're investing based on what you think is going to happen in the future, but based on today's numbers, it's overpriced. So then how do you decide? That's a big reason why I don't believe in trying to pick stocks, because we have no way to predict the future when it comes to the market. I'd rather use proper fundamentals. So, managing earning expectations, I'm going to skip over that. I'm going to go to the part that I think is very prudent or on top of mind because it's happening next week. The election. The election is a coin flip, they say. The U.S. presidential election is naturally dominating the minds of most investors. When faced with such uncertainty, it is tempting to position portfolios to benefit from a particular outcome. Such a strategy is grounded in the assumption that other investors have mispriced the probability or impact of that outcome. While that may be true in some circumstances, it seems unlikely this year, given how close the race is. This means positioning a portfolio for a particular outcome is literally a coin flip, and one should not, I repeat, not risk a lot of capital on it. We should instead be positioning our portfolios to withstand a range of scenarios and looking for opportunities that the market adjusts to whatever new political reality emerges after November 5th. To this end, Danny Noonan recently laid out an evidence-based approach to addressing politics. So I've read so many articles recently around this that show that elections have very little impact on the markets. Now, they impact them, but there's no consistent correlation between one party winning and the market going up or the other party winning and the market going down. It's almost random. And almost all the time, the market's up in election years. So even though the news tries to sell you all this negative stuff, and oftentimes the politicians try to tell you the world's going to end if the other party wins, the markets still grow, right? So it's really important, especially at this time of the year, but all times of the year, to completely disconnect what you hear in the media from what your investment fundamentals are, because the markets do not follow the media, right? A lot of what the news we hear today has already been baked into the markets because the people who are like the big institutional investors or the politicians or the people that run these companies that have insider information have already made their moves, right? Or when it comes to the S&P 500, the companies that are grown significantly to join the S&P 500, people have already bought them before the S&P 500 could rebalance and update the index. So again, updating your investment strategy based on what you hear today, tomorrow is rarely a good strategy. So the economy is accelerating, approaching Halloween, that's today. There are plenty of opportunities for nasty shocks this week. The GDP data for the third quarter of 2024 will be released. The U.S. economy is expected to have grown by 3.5%, accelerating from 3% in the second quarter. That's good news. We'll also see inflation data from the Personal Consumption Expenditures Index. The core measure is expected to have fallen from 2.7% to 2.6% over the last year. That's fantastic. So what that's saying is the growth of our economy has gone up from 3% to 3.5%, while the cost increases of all the things we already buy has gone down from 2.7% increase to 2.6% increase. So in theory, we should all feel a little bit financially better in the next 6 months or the next 12 months than we did the last 12 months, assuming something doesn't drastically change. In theory. The latest U.S. employment report will also be released Friday. Since this data is backward-looking, it should have little impact on investors' decisions. What I just said, right? The latest U.S. employment report will also be released Friday. Since this data is looking backward, it should have little impact on investor decisions, and yet I can almost guarantee you there will be at least one person you know who will read about that or hear about it, and then they'll go out and make an investment decision. Even though it's from the past, it's not about the future. The election and the Federal Reserve meeting loom next week, and we can expect this news to create volatility and the headlines. It'll be volatility in the headlines, but again, whatever the Fed does, institutional investors and the big guys have probably already baked in those prices into their decision making. Big tech and energy stocks to report. Earnings season continues with Apple, Amazon, Eli Lilly. I I'm actually not familiar with Eli Lilly. And major energy companies in the spotlight this week. You can learn more about what's happening with our market calendar and dedicated earning page. That's just a sales from them. All right, that's kind of all I think is worth highlighting in this article. It's 8:56. Any questions, comments, concerns, or remarks from the audience? Again, we'll post this article in the comments in case you want to check it out. I only highlighted some of it, not all of it. And just because I highlighted it doesn't mean I agree with all of it. See if I can find one more short one. Or hopefully get some questions. I'd love to answer those. Why Americans aren't prepared for retirement. Let's go with that one. By Morningstar. Easy place to pull information from. That's why I often use their highlights, and they're a well-respected company. So, by John Reckenthaler, this article is titled "Why Many Americans Are Not Prepared for Retirement." Retirement readiness is improving, but not quickly enough. The long route. Most retirement studies are calculated on the back of an envelope. Not literally, of course, but figuratively. They take shortcuts. They base their conclusions on wealth percentiles rather than the circumstances of individual households, and they determine success by measuring whether the assets associated with those percentiles will be able to achieve a specified level of retirement income, which is called a replacement ratio. Morningstar's Jack Van Der Heij and Spencer Look of the company's Center for Retirement and Policy Studies have taken a different, more laborious approach, beginning with the detailed information on 3,442 households taken from the Federal Reserve Survey of Consumer Finances. They then project 1,000 potential life paths for each household, considering potential changes in savings rates, withdrawal patterns, job turnover, and healthcare costs. To invoke the jargon, the authors use a stochastic decumulation module. I have no idea what that means. If you drop a term like that at a party, you'll have people asking you to invest their money. Trust me, I know. That avoids rules of thumb I don't like what he's talking about. He's basically trying to say that fancy word will get you clients. The result in this model is that can thoroughly address a wide variety of questions, which the authors have begun. Okay, skip ahead. This is the background. Cool. All right, retirement preparedness across their generations. Van Der Heij and Look divided their participants into three age cohorts. One, Generation X, defined as those born between 1965 and 1980. Two, Millennials from 1981 through 1996. And three, Generation Z from 1997 through 2012. The chart below shows the computed success percentage for each group, assuming the Social Security system remains intact. Neither presidential candidate appears to harbor the slightest worry about Social Security's viability, although perhaps that it is not quite the assurances you seek. So, what this says is, I know you can't see it, but I'll include the article again. Full retirement readiness by generation. Gen X, about 53%. Millennial, 56%. And Gen Z, 63%. And that's their funding ratio. So their ability to essentially projected success rate that they're going to be able to maintain their lifestyle once they retire. Those aren't great percentages. So Gen X is at about half, 53%. Millennials, 56%. Gen Z, 63%. So again, very, very, very important to start your retirement planning earlier rather than later, because there's no better time to start than today. And if you don't start today, there's no better time to start than tomorrow. Those figures aren't great, although at least the trend is upward. Then again, when were they better? While I cannot answer that question, I suspect the correct response is never. For example, in my immediate family, the success percentage for retirement funding was 25%. My father and brother, not mine, the writers, his father and brother both lived solely on Social Security a few years after they stopped working, as would have my mother had she not remarried. Our story is not unique. So the question is, do you want to retire and live solely off Social Security? If the answer is no, you need to start planning as soon as possible to make sure you have other options and other assets to live off of in your retirement. The income effect on retirement preparedness. The average looks much different after adjusting for income levels. The outcomes spike for the wealthiest quartile as measured by their current age-adjusted earnings. Traditional corporate pensions may have largely vanished, but their twin replacement of 401k and IRA plans appear to have filled the retirement planning gap nicely. That is, for those who have means. So basically what this is saying is that for Gen X, The highest income earners have an 89% retirement preparedness. The second highest, 63. The third highest, 47. The fourth highest is 14. So, and that's kind of carries over for all the generations. Essentially, the more money you make, the more likely you'll be prepared for retirement, is essentially what this is saying. The rich get richer, and they start that way. And they go on talking, and that's kind of the main point of this whole conversation. And I think I would like to push back on that a little bit. Of course, the more money you make, the easier it is to save for retirement because you have extra income. However, we have met with people who make $50,000 a year their whole career and have millions of dollars in their 401k or their overall retirement accounts. It is possible, so don't give up on yourself just because you don't make a ton of money, right? Try to find ways to spend less than you make. Try to find ways to save money. Buy a duplex, rent out the other half. Have a roommate. Whatever it may be, do your best to set aside one more dollar today than you did yesterday for your long-term retirement rather than getting sucked up into buying something you don't need. All right, so thanks for your time and I hope you have a great day. Bye.